What's up, team? Welcome to Wealth with Kai, and today I'll be going over my September recommendations that I made at the start of the month, as well as introduce you all a brand new public portfolio I've set up for YouTube. Before we get started though, as always, this video is for entertainment purposes only, so please don't treat anything that I say or show as financial advice. My entertainment shades are now on, so let's get right into the content. So, here's just a quick overview on the stocks I've picked in to go into the portfolio. The portfolio is still less than a week old. I set it up on Tuesday New York time right before the Fed's meeting, so there was a little bit of risk depending on what came out of that meeting. I've also tried to diversify my picks in terms of the industries they represent, as well as how long I potentially might hold on to each stock for. Here's a list of the stocks. There were some honorable mentions like AMC might have replaced Alibaba, and DraftKings might have been replaced with Goldman Sachs or CleanSpark. Before we look into this portfolio, just a few quick announcements. Firstly, we will start this portfolio with very humble beginnings, only 1,200 New Zealand dollars. I think this is a good number for a few reasons. Firstly, it's not exactly a big sum, so it can show those that think, oh man, I need $10,000, $100,000 to make a proper difference. No, you don't. It's also not like a super small amount either, which means you have a decent chance at establishing a few solid positions in companies that you genuinely believe in. With 1.2k, say you make 15% return in 3 months or 6 months, which by normal standards is already really good, it's pretty much an almost extra $200 that you have in your pocket that you otherwise wouldn't have. And again, $200 in the grand scheme of things is not exactly a lot, but it can potentially cover the coffee bill for a month, and it's also enough to maybe treat yourself to something pretty nice. Also, just so I am being transparent myself, for me personally, like $1,200 starting up is a very reasonable and comfortable amount that I feel safe when I showcase to the internet, as well as all you viewers on YouTube. I'm also not exactly the richest kid on the block. I have my own bills to pay. I got a home mortgage to service. My private portfolios require my attention as well. So yeah, all in all, $1,200 with potential regular top-ups is a really good place to start off. And as the portfolio is relatively small, we are going to pay more attention to the percentage returns rather than how much money we are making. We'll see how this goes, and who knows, maybe over time this portfolio will become a 5 or 6 figure one anyways. Maybe even 7 figures, maybe $1 million portfolio, who knows. So, before I show you the portfolio, I just need to emphasize finally that there is risk here. Definitely more risk when compared to investing in a standard ETF like Vanguard. So do as you will with my picks, but please also do your own due diligence and be responsible with how much money you can invest in. Now that's out of the way, let's hop onto Hatch, look at my positions, how we'll track them, and then conclude the video with a quick stock analysis on each of these companies, as well as how I did on my recommendations going into September. My next video will be a stock recommendation for October, so yeah, just keep your tabs on that. Let's hop right into Hatch. So, for those that don't know, this is Hatch. It's a platform that allows Kiwis to invest in the US stock market. I've topped up 1,200 New Zealand dollars. The excess from this is based on any gains or losses that my portfolio has experienced, as well as any referrals that I've had since opening up Hatch. Now, as you can see, this does not add up to the total return over here, because if this was correct, this should be $39.29. And because of that, we are actually not going to stay on this website for long and rather use Excel to track our actual progress. Now, the reason why we're on this website though is just to show you all that I do have positions established. So yeah, they tell you the percentage it takes up, the company, the amount of shares that we had, the price that we bought these shares at. Currently it's in New Zealand dollars, I believe. So if we could also switch and track everything in US dollars, the current price, its current value, and whether we are up or down on the stock. Now, another thing I need to point out is this total return is different to this total return as well, probably just because this doesn't take into account dividends and is just primarily based on the percentage gains over here, as well as the current values and stuff like that. Now, the website is quite easy to use, although it actually wasn't my first choice. So I would have actually preferred using Sharesies, but what Sharesies does is it also includes the US, Australia, as well as New Zealand stock market. And because I have positions in Australia and New Zealand as well, I just felt like it would be too annoying to juggle around between the platforms. Stake, it's the platform that I use the most. It's where most of my money is placed in, and it's where I pretty much do the most active trades, And because I am really active on that website, I feel like I won't be able to update you guys on YouTube as frequently. So yeah, just because the purpose of this portfolio is just to show investing rather than trading, as well as how these stuff can accumulate and compound our wealth over time. Hatch is pretty straightforward with their fee structure, hence we are using this as a platform. Now, I'll just bring the Excel sheet over so we could go into how we'll track everything. The first tab is not that useful for our sake, it's just a currency converter. Because I'm in New Zealand, it's just easier to gauge in how US is doing compared to New Zealand, and then incorporate it into all my Excel sheets down below. So yeah, it's a pretty neat tool though. If you guys are wondering how it works, you can easily Google it. But essentially, I just have to refresh this, and this automatically updates the US dollar to New Zealand dollar conversion rate, and then that automatically updates all these Excel sheets down here if they are required. So if we just hop into the Hatch one, similar to what the website that we went on just then shows, we have the stock, the amount of shares I have, the price at purchase in US dollars, the value at purchase in US dollars, the hatch fee, which I've converted into US dollars just for consistency, its current price, current value in US, current value in New Zealand, and the total gains and losses. So these gains actually do incorporate in this hatch fee, so it does more accurately depict how much money we are generating or losing after the platform charges its fees. Now, we also have that as a percentage figure over here, as well as New Zealand dollars. So as you can see, SoFi is doing really well, but like I said, SoFi was a position that I established a couple weeks earlier compared to all the rest of these companies. So yeah, that gives me kind of the more unfair advantage over what we're going to compete against. But then again, what we're going to compete against, they don't have to deal with this hatch fee. So I think overall it's broken even for the time being. So how will we track how we do? There's our total gain percentage over here that factors in all the stocks, all the companies, everything going on, and we have VU. So at the time that I bought all these stocks, VU was trading at just under $400. I've rounded it to $400 just for the sake of accuracy, and we're just going to see how well our portfolio does compared to how well VU does. So currently, since this portfolio has been established, VU has risen 2.36%. We've been up 2.66%, which is why this tab is green, because that means we are doing better. However, because the time is so short, there's actually not much to prove at the moment. We will have to see, and time will tell. Now, I do intend on topping up this portfolio with new stocks as well as more money, obviously, but that's not going to directly go into this challenge, because we are just going to strictly keep these stocks as part of outperforming, and the new stocks that I add, the new money that I add, will just to demonstrate the power of dollar cost averaging, compounding our wealth, as well as just how to exactly grow a portfolio over time. Now, that is everything that I wanted to show on this Excel sheet. Because we haven't sold anything, the tabs going across show how we could gauge the gains and losses when we buy and when we sell. And the rest of these tabs down here are just other elements in my life that we're not too worried about. So I'll save this. We'll go back onto PowerPoint. I'll kind of do a brief stock analysis on each of these stocks I picked before going into any remaining September recommendation stocks that I had at the start of the month to analyze them before we conclude the video. Sweet as. Let's go back onto PowerPoint. So, Citigroup is my banking pick. Banking stocks are really excellent hedges against inflation. You can see that after the Fed's meeting, Citigroup, as well as a lot of other banking companies, did experience a pretty nice pop. Lucky for us, we got in right before this pop occurred. Citi also pays dividends, although it's quite insignificant in our case since our portfolio is quite small, and its PE ratio is pretty standard for a banking company. Other banking stocks you can look into getting a position in include Goldman Sachs, Morgan Stanley, JP Morgan, etc. And as inflation gets factored in and seeps more into 2022 and beyond, you want to have some of these banking stocks and blue chip companies to stabilize and de-risk your portfolio. However, it isn't just the inflation and risk element alone. Look at the growth of Goldman Sachs in a single year. Many other banks did also experience similar runs, but 1 year ago today, I don't think I would have believed you if you told me that you can double your money essentially by investing in Goldman Sachs. I did hold Goldman Sachs around the November-December period, and then I wrote it up till around April back then. So I've already experienced some really reasonable and happy profits with the company, but I will consider re-entering it if the price suits. It was definitely a really big toss-up between either having this or Citigroup in the public portfolio, and spoiler alert, Goldman Sachs will definitely be one of the recommendations I have going into October. Now, The portfolio, as you saw, also had SoFi, another one of the stocks that I recommended at the start of the month. And would you look at that? On this single month alone, it is already up 18.8%, and it would be up even more if you got in earlier. Now, assuming no sudden big catalysts, I can see this going into the $20 price range, and you guys already know the YouTube portfolio has it. I got a whole lot more in my private portfolio at around $14 as well. I'm expecting great things from the company. Next, I will now say I'm not personally a big believer in crypto, partially because I don't fully understand it. But I think if there is money to be made, I don't want to miss out. You can see that in the past 6 months, Coinbase has been getting hammered. Since its IPO, it has been really volatile as well, but it has been overall trending down. This is particularly due to China's recent blanket ban on crypto as a whole, but this also makes a pretty comfortable price for me to get into it, and the outlook of crypto is still looking pretty sweet. Tesla still has their Bitcoin as far as I know. It's still a legal tender in El Salvador. All the large financial companies, hedge funds, banks, etc. are all getting the piece of the pie. And AMC also announced that they will hopefully accept crypto as payment by the end of this year. So although it's just going to be a volatile journey, I am in for the ride up. Next is NEO. We have a small position in my public portfolio, and it was another September recommendation I made at the start of the month. As you can see on the month, it is also down. I told you guys I like the price at $40 in my earlier video, so I'm telling you now that I absolutely love it if I am buying it at $35. But why has it been dropping? If we just have a look at the Hang Seng Index, which is a really good tracker for the Asian market, it is officially in the bear market territory. Officially down around 13% in the past 6 months, but if we dragged it out maybe to a 1 month or 3 month chart, it will be down 20 something percent probably, and that is actually just bear territory. If you look at other Chinese EV companies or just Asian companies or stocks listed in Asia as a whole, you will see most of them or a lot of them are also getting beaten down similar to NEO and experiencing similar trends. I did say NEO is favorable for long-term investors, so right now is a good time that while the entire Asian market is down, it's nice to nibble in, establish your positions, and just keep a close eye on any potential risks or news. Nothing too major to worry about as of yet. I'm already loaded up, I like my average price, and I'm holding it out. Also, on some more positive news, Norway also recently announced that their vehicle sales will all be EV by the end of 2025, and NEO will be a big part of it. Once these chip shortages are solved, COVID gets better and delivery starts pumping up, good things will happen to the company and to the stock. Also, just as another technical note, I have observed that every time it has hit around this $35 level, it has bounced back up quite quickly. Obviously, I can't predict the future, so yeah, we will have to see about that. Our new YouTube portfolio also has ChargePoint, another one of my recommendations at the start of the month. Since my recommendation, it's been down around 10%, but that is the name of the game. We find good companies, we buy low at these prices, and then we ride the wave back up. It's opportunities like this that while we're still waiting for the infrastructure bill and everything else that's going on, that we can give ourselves a really good chance to find really good deals, establish our great positions, and then prepare for takeoff once it happens. I'm not stressed at all at the moment. We have it publicly, I got it privately, I'm just going to expect good things. Next, we got Cleveland Cliffs. This is my industrial play for more diversity in the portfolio. It's a blue chip stock. We got it at around this period over here, so under $20, which I believe is an absolute steal, and we're already up more than 5% in less than the week. Although it is down 17% on the month, it would be up even more, or at least our position would be up even more if it wasn't for those hatch fees, and I think this stock itself would have been better if it wasn't for the Evergrande situation that I will touch up on later. Now, I don't own the stock privately yet, but it is on my radar, and if it does drop below $20, I will see how far it bottoms out and then nibble in and eventually load the boat if I feel like it is a value play, which I do believe it is right now. Now, next up we have Alibaba, which I did put into this portfolio, and it is currently down. On the month it is down even more. I did warn you all at the start of my September recommendations video that this is a high risk investment with all that's going on in China, and with the Evergrande situation it might not even be the cherry on top. But what exactly is going on with Evergrande? Pretty much, real estate is a ridiculously large market in China, even when compared to any other country, because real estate as a whole is already a really large industry. And Evergrande is pretty much one of the largest, I think the second largest property developers in China. Like many parts of the world, including New Zealand where I live, house prices have been absolutely skyrocketing. Therefore, their assets, in this case property for Evergrande, keeps inflating because of the rising prices, which gives developers like Evergrande more leverage. More leverage means more borrowing power. For those that don't know, just as a general note as well, land and real estate are pretty good counters against inflation. But essentially with Evergrande, the CCP, which is the Chinese Communist Party, saw leveraging as a problem and implemented some metrics that Evergrande failed in, which prevented them from borrowing more money. It gets kind of complicated from there, but you can think of it as because they can't borrow more and that they owe a lot already, things had to get sold for cheaper and probably quicker. This slowed down the growth of real estate market and its prices, and because this market is so big, its flow-on effects can be experienced across different industries and countries. On this note, one great example of this is Vale. It is another stock that I recommended as a long-term investment in my September video, and they took a hit because now steel demand is lower. And if you haven't really pieced it together, building infrastructure requires steel. China's a huge developer that took a beating, so there's less demand for steel, which means ultimately less profit for Vale. Hopefully you guys get the idea. And just on a scale of how big we are talking, how much Evergrande influences this thing, Evergrande is currently around 300 billion US dollars in debt. And if I remember correctly, this roughly equates to 2% of China's GDP. Now, some stock analysts take this as a buying opportunity for stocks like Vale. Others think of this as an opposite scenario where there is more room to fall. My stance on this as a long-term investment is still the same. I own the stock at an average price of around $16 to $17, and I forecast that future infrastructure development will continue to soar in order to accommodate our growing population, our growing demands, and our growing needs. I'm currently down at the moment, but I am not too worried. But back to Alibaba, I do need to flag another risk. With Alibaba, you are essentially investing in an offshore shell company because China actually doesn't allow for direct investments into their businesses. I picked this stock because I think things will get sooner or later, and it is a small risky position that kind of spices our portfolio up. This might give us more content to talk about because if it does bad, we can analyze why, and if it does good, we can profit and then analyze why. Be greedy when others are fearful, and be fearful when others are greedy. And in the case of Alibaba, maybe it is worth being very cautious as there is a lot of FUD still lingering. And if you didn't know, FUD, F-U-D, stands for fear, uncertainty, and doubt. Now, we have DraftKings. I believe this is the final position in our portfolio. It has also taken a beating on this month as well, mainly because of reports suggesting it potentially acquiring Entain, which has a partnership with MGM. MGM is another gambling company as well, and this acquirement caused MGM to pick up some momentum and DraftKings kind of to experience the opposite. The drop price made me comfortable with having it in our public portfolio as a scouting ground because I don't own any of it privately, and like I said, similar to Alibaba, if it fails, it does make a good talking point, and if it succeeds, we could profit of it. So yeah, it is a risky one that may or may not pay off, but ultimately I still think the gambling industry is huge, and with NBA season looming and as more states legalize and update their policies on gambling, I see this as a great pickup. If the stock does well from here, good for us, and if it doesn't, there will be lessons to be learned. So, I have covered my portfolio very briefly. Comment below if you have any questions. I plan on updating this portfolio maybe once a month or whenever I top it up and buy or sell new stocks. I might have been quite brief in covering this because it's literally been less than a week old. And yeah, just let me know if you want more detail on this portfolio. Maybe I didn't brush up on the Excel sheet that much, but as you can see on this table over here, we are in the green for most of it, and overall we are profitable so far. Less than a week, so yeah, we will have to see how things go. Let's move on. Sweet, and I've pretty much covered a lot of the September recommendations as we went along my public portfolio, primarily because I bought a lot of it and some of it was indirectly influenced, like Vale, which took a big dip, and others like SoFi was pretty big W's in my books. Now, let's continue with what other recommendations I had in September and how they did, and we'll start it off with a bang. Palantir, it was a recommendation I made at the start of the month. It's up more than 17% on this month alone. It's up even more if you bought it earlier, and as I said, it was on that trajectory to break that resistance level. I swear if it wasn't for that entire market dip that occurred last week, I think the stock would already be touching $30 by now. But for those wondering, I already have a heavy position in this privately at around $22, so it was a pretty big contemplation on whether I wanted to add it into the public portfolio or not. My other recommendations were Zoom, Amazon, PaySafe, and Chewy. Zoom was around $298 at the time I recommended it. It's dipped more than $20 since then. I did recommend it as a long-term stock, so these short drops and rises shouldn't be worth stressing over, especially if you are dollar cost averaging in. I don't personally own Zoom as a stock, but that doesn't mean it doesn't make for a potential great pickup, and if you did buy it, I would personally keep the position quite small for the time being. PaySafe has also dipped on the month. This one I do own at an average price of around $9, so I am currently a bit down, but I still think this is a great and excellent growth stock that is in for a rebound sooner or later. For Amazon, my recommendation was primarily based off a potential stock split. I still believe this will occur in a matter of time, so if you bought it, holding it is not a bad idea regardless of the stock split or not, because it is still a great company to have a really firm position in. Now, I don't own Amazon, I just need to make that clear and out of the way. The final stock I did talk about was Chewy as a stock to put on your radar. I did warn everyone that this stock is a falling knife and is a super high risk play. It is still currently dropping, so for the time being, I would recommend just keeping it on your radar, and we might ride a wave back up for this stock later on. So, that brings us to the end of the video. We went through the good, the bad, and the ugly of my stocks for September, as well as gave a very brief overview and introduction to the YouTube portfolio. My next video will be on October stock picks, so please stay tuned for that. And if you made it this far, thank you all for tuning in. Remember to comment, like, and subscribe if you had a good time. And I also have referral links down below for those that want to start their investment journey. My entertainment shades will now be off, so I'll see you guys all next time. Peace out.